Advanced Accounting Part 1 in a 5-part series covering Chapter 3, and it has to do with accounting for 100% consolidated subs subsequent to the date of acquisition, which means you have bought 100% of the stock in the subsidiary. In this case, they haven't been dissolved, and now time has gone by. How do you account for those changes? We need to recognize the complexities in preparing consolidated financial reports that emerge from the passage of time. Hence, you must determine if there is any overvalued assets at point of sale, determine annual amortization, depreciation, we use them interchangeably here, determine if there's any goodwill. Remember, as time passes, you must adjust overvalued assets for passage of time, which means you have to adjust the balance for previous amortization. So you're going to use the net book value as of the beginning of the year. For consolidated totals, the subsidiary's retained earnings, common stock, and additional paid-in capital should be eliminated as part of the consolidation. Only a parent's amount should be shown. Now, investment accounting by the acquiring company. Record keeping if the parent can exert control of subsidiary. External financial reporting. Consolidation is required. Internal record keeping. Parent selects an investment account method to monitor activities. And there are 3 prominent methods, which means there are more, but these are the ones we're going to discuss in this presentation. The first is the equity method. Then we have the initial value method, and then we have the partial equity method. All right, let's take a look at our example. This is for December 31st of 2017. So on January 1st, Big acquired all the stock of Little for $680,000. They also paid stock issuance costs of $10,000. Little had copyrights with a book value of $440 and fair value of $560, and a remaining life of 6 years. As of December 31st, what is the consolidated goodwill, consolidated copyrights, what is the consolidated net income, and what is the consolidated retained earnings? This is similar to your homework problems. All right, so first we need to determine if there is any amortization or goodwill. Okay, what is the consideration? It was $680. What is the net book value of Little? Which is, to determine this, we have to use the equity balances because the assets and liabilities would reflect current year activity, and we need net book value of 1,127. So we take the common stock, the additional paid-in capital, assuming none have been issued during the year, and the beginning retained earnings, so it gives us 480. And now we have excess over book of 200,000. We know that we have the undervalued patent of 120 divided by 6 will give us $20,000 a year amortization, which gives us $80,000 in goodwill. So as of December 31st, what is the consolidated copyright? It would be the parent's copyrights plus the sub plus the adjustment at the date of purchase minus the amortization for the year. And our consolidated value for copyrights is $1,000,004. Now, what is the consolidated net income? Well, we take the revenue of the parent and the sub. We take the cost of goods sold of the parent and the sub, and the depreciation of the parent and the sub, and then, of course, the amortization depreciation on the undervalued assets. And now we have $380,000 consolidated net income. What is the consolidated retained earnings? We start with the beginning for the parent, plus the net income, less the dividends, gives us total consolidated retained earnings. We do not include Little's retained earnings or dividends because they are eliminated as part of preparing the consolidated financials. So now let's take a look at another example. On January 1st, 2015, Big acquired 100% of the outstanding stock of Little for $600,000. Little had net assets of $420,000. They also had equipment 8 years, undervalued by $80,000. Any excess was attributed to a patent with a remaining life of 4 years and is not on Little's books. Big uses the equity method. Each year since the acquisition, Little has declared a $20,000 dividend. Little also has net income for 2015 of $70,000 and $80,000 for 2016. Additional information for 2017. So now we have the information we need. What is the consolidated net income, retained earnings, equipment, and patent for Big at 12/31/2017? All right. So consideration from Big, net book value Little, means we have excess over book of 180. Take away our undervalued equipment. So we have a patent valued at $100,000. So now we have total depreciation and amortization of $35,000. Now, consolidated net income for 2017 would be Big's and Little's adjusted by the amortization depreciation, which gives us consolidated net income of $203. What is the consolidated retained earnings? Because using the equity method, Big is $250, and that's all there is to it. We don't have to make any adjustments at all. And of course, we don't include Little because that's wiped out as part of the consolidation. What is the consolidated equipment? It would be the parents plus the subs adjusted by prior year amortization, gives us consolidated equipment of $1,050,000. Value of the patent, amount assigned to the patent, less 3 years amortization, gives us $25,000. And that ends presentation for Part 1.